Investors like Warren Buffett or Elon Musk make billions in profits on clean energy. Obviously, we all want to get in on this trend, but how do we avoid putting our money in the wrong place? Here are 5 strategies for anyone to follow to find a suitable investment strategy in green tech. After that, we are also going to look at 3 specific types of investments you can make today in the growth of new energy technologies. It'll be a good one, so stick around to the end. As world economies keep developing, the focus is shifting from fossil fuels to clean or renewable energy sources such as wind, solar, or hydropower. In fact, scientists expect total worldwide energy usage to grow by approximately 50% by 2050. There's a huge market opportunity for investors looking to profit from green energy investments. However, just like a tick in time saves 9, look before you leap is real-time investment advice. The big question about investing in clean energy stocks is, how do you know if a clean energy stock is a good buy? In this video, we'll reveal the top 5 things to look for in clean energy stocks. We'll also walk you through a successful investment journey by showing you the best ways to invest in clean energy. If you're looking to take advantage of the growing renewable energy markets, this video will serve as a guide to investing, so it'll do you good to stick to the end. And while we're at it, please hit the subscribe button now so we can get you more tips in the future. Now, let's jump right into the video. Since 2020, clean energy investment has shown significant acceleration, growing at an average annual rate of 12%. Presently, it accounts for nearly 3/4 of the growth in energy investment across the board. The current tailwind to this increase has been identified as investments in renewable power, greater energy efficiency, and electric vehicles. Generally, the renewable energy sector is at the forefront of technological development, resulting in lucrative breakthroughs. The International Energy Association rightly describes this progress as a significant step in the right direction. However, what's even more interesting is that the demand for renewable energy is only expected to grow since the world's population isn't getting any smaller. According to the U.S. Energy Information Association, nearly half of the global energy production is expected to come from renewable sources such as wind and solar power by 2050. While for some people this is a random piece of information, for investors this can mean not only steady but increasing returns over time. So if you're considering investing in green energy, you're on the right track by all indications. Now that you know that renewable energy stocks are big fishes, it's also important to know that successful investment is beyond being optimistic. To improve your odds, you must carefully examine the stocks against various investment factors. That said, let's X-ray some major things to look for when investing. Number 1. Energy source focus. When investing in clean energy stocks, the energy source focus is the first factor to consider. Here's what you should know. There are different energy sources, and some are more likely than others to make up a significant portion of overall energy production. Hydropower is already the most widely used renewable power source, with a global installed capacity of hydroelectric plants exceeding 1,200 gigawatts. It also accounts for over 54% of the global renewable power generation capacity and almost 20% of the total installed power generation capacity. However, globally, much of the potential hydropower has already been used up. So unfortunately, while this power source remains significant today, it doesn't represent the most considerable growth potential for renewables in the future. Many countries, especially China, are rapidly exploring the potential of faster-growing wind and solar energy resources, making these energy resources increasingly popular. So there's a higher potential for returns with companies investing in these sectors. Number 2. Financial strength of companies. Another critical factor that affects your clean energy stock investment is capital availability. This is not to discourage you from investing in young and growing companies. Some young energy companies have excellent growth potential, but let's face the facts. Watch cash flow. Good cash flow is crucial when you're looking for solid, long-term investments. Take significant energy companies like First Solar and Brookfield, for example. These companies have robust infrastructure and financial resources to drive operations and invest in major projects that affect the profitability of their stocks. This may be different with young energy companies. They may have great ideas and opportunities, but the lack of financial resources and infrastructure will deter expansion and revenue growth. Choose your investments carefully. Number 3. Competitive advantage. The third is the stock's competitive edge. In business, a competitive edge or advantage is the peculiarity that allows a business to outperform its competitors. For example, if you own a beverage company and decide to produce a 3-in-1 beverage that no competitor is making, this innovation becomes your competitive advantage. In other words, a company's competitive edge puts it in a superior position. In clean energy stock investing, you should examine the company's uniqueness, differentiating it from competitors. This could be anything from proof of unique and well-tested technology, the high adoption rate in significant countries, access to high-quality labor pool, or peripheral access to new and relevant technologies. Number 4. Growth drivers and barriers. Knowing the growth drivers and barriers to growth is also essential information that lets you assess the company's attractiveness. One of the things to check for is a company's technological strength as it relates to its production process. If the company lacks the necessary infrastructure to carry out its operations and further increase productivity effectively, that might be a red flag. For example, we can think about Ford Motors versus the German brand Daimler. Daimler, the owner of the Mercedes brand, has decades of experience creating super high-quality, digital, automotive experiences and luxurious interior user interfaces. Ford, meanwhile, is great at the craft of combustion motor engineering but has yet to be known for elegant interiors or digitization. Who will succeed in a world shifting toward user experience optimization and digitization of vehicles? Ford indeed has released new electric models and announced even more promising ones, but Mercedes has released an entire series of cars called the EQ series and, despite their slow moves as an organization, looks like a significant contender to accelerate past other major car brands when it comes to electrification and digitization. Number 5. Scope of operation. Lastly, examine the scope of the company's operations. Is the company operating locally alone, or is it intentionally diverse and promised to take advantage of international developments? Regardless of the nature of the business, building an internationally diverse strategy to solve global issues is a crucial driver of success. Successful companies will establish their presence in domestic and international markets to boost and grow profits. Look for companies that are established and operating in the core markets they're guaranteed to succeed in. Wind energy company Ørsted is headquartered in Denmark, a very windy country, and is growing its business on the North American East Coast. That's a good sign of a focused company. So there it is. That's 5 things to consider when investing in green tech. But what use is this if you don't know how to actually start investing? As we said, we'll cover the specific avenues you can take to put your money into green tech. Let's have a look at that now. Before we get there, though, we'll make a quick pitch to you to hit the subscribe button to make you aware of more green energy tips and content. Just go ahead and do that now, and we'll move right along. Generally speaking, there are 3 core ways to invest in renewable energy. You can either 1. Invest in clean energy ETFs, 2. Buy shares in individual companies, or 3. Invest directly in green energy projects. Let's take a critical look at each of these investment methods. The first way to invest in renewable energy is by investing in energy exchange traded funds, ETFs. This is the easiest way to invest in clean energy. Clean energy ETFs are investment funds that track the performance of a specific stock market index related to clean energy. When you invest in an ETF, you buy a basket of stocks traded on an exchange. Think of an ETF as a grocery basket containing milk, sugar, and eggs. Rather than seeking out and purchasing each item individually, you buy the entire basket and have all the content in one go. You let someone else decide the correct basket of renewable energy stocks and let them assess the quality. When you invest in a clean energy ETF, you get a share of all the securities that make up the fund. The most significant benefit of investing in an ETF rather than an individual stock is diversifying your investment portfolio and lowering your risk and exposure. ETFs are very liquid, so you can quickly liquidate your position. Most clean energy ETFs track the top stock indices, such as the S&P or NASDAQ Clean Edge Green Index. While investing in ETFs is very easy and offers other benefits such as diversification and lower investment risks, it's essential to understand the components of the ETFs before you invest, such as what exactly they're tracking. While trying to gain from broad-based renewable energy funds such as these ETFs, you may take different types of risks. Some renewable energy portfolios might be weighted towards a specific energy type, such as wind or solar energy, while others may focus on a single country. Do the research and look for a well-balanced portfolio that fits your general worldview. The second method of clean energy investment is purchasing individual pure green energy stocks. This means buying stakes in renewable energy companies listed on the stock exchange, such as those that produce solar cells, zero-carbon utilities, or project developers such as Ørsted mentioned above. One good thing about individual stock investing is its simplicity. However, these stocks may carry more risks since share prices can be highly volatile. It's also considered a long-term investment, so you may have better alternative options if you have a more short-term financial goal. Lastly, most advisors will tell you that it's crucial to scatter your investment across different stocks to spread your risks rather than put all your eggs in one basket. The world is full of bankrupt solar cell manufacturers. Who has the winning technology? Nobody knows. However, choose the right ones and you'll have an investment portfolio for life. As we wrap up this section, your final option is to take a stake in a new solar energy or wind farm project, for example. However, these are seen as very long-term energy investments. Practically, earning returns on investments depends on when the project matures and starts bringing profits and notably on the capital you have available. Also, with this strategy, you usually don't get to diversify your investment. Instead, you're putting all your money into one single project that might fail. If the project fails, you lose your money. However, alternative ways exist to invest in single projects. An example of this is solar or wind crowdsourcing. This works by letting you, as well as a group of other investors, combine your capital to finance one single project. Check out the links in the description for examples of crowdsourcing companies and services if you're interested. Before you invest in a green energy project, ensure that the relevant agency regulates the firm you invest in. In the US, this would be the Financial Conduct Authority, FCA. How do you check if the FCA authorizes a company? Simply check the FCA's Financial Services Register using the name and address of the firm's registered office. Other countries will have their own regulatory agencies. As the world continues to fight against climate change, coupled with the ever-increasing cost of fossil fuels, the demand for green energy as an energy source is exploding. And in investing, a strong demand tends to make a good case for investment profitability. Aside from having room for growth, portfolios of green energy stocks offer more stability than traditional stocks as they're less impacted by economic downturns. Renewable energy stocks are a great option if you're looking for a more future-conscious way of investing. However, before backing renewables with your money, you should always conduct due diligence to determine if the investments suit you. It's always best to consult an experienced investor to guide your investment journey. Thanks for watching. The subscribe button is right there below. Please hit it if you want to get unique and valuable investment advice related to renewable energy in the future. We'll get much more specific in the future and hope you'll be around for that. If you have any comments, please write them below. Also, check out these links to other great videos on green tech and climate change while you're here. In the meantime, and until next time, shine on.